In 1929, people jumped from buildings. In 1997, entire currencies collapsed in weeks. In 2008, the global financial system froze. Not slowed, froze. And in 2020, governments shut down the world economy on purpose. Here's the uncomfortable truth. The biggest economic crises in history weren't accidents in the usual sense. They were pressure releases, built slowly, quietly, inside systems that looked stable until they didn't. And right now, many of the same ingredients are back on the table. If you think crises are rare events caused by a few greedy bankers or bad politicians, you're missing the real story. The real story is structural. It's about incentives, leverage, fragility, and something we call confidence, the most important asset in the global economy. Let's go through the biggest economic crises in modern history, not as a list, but as a pattern, because once you see the pattern, you can't unsee it. Start with 1929. The roaring 20s in the United States felt unstoppable. Stocks only went up. Ordinary people borrowed money to buy shares. You could put down 10% and borrow the rest. If the market kept rising, you doubled your money quickly. If it didn't, well, no one wanted to think about that. This was leverage, and leverage is financial gasoline. When prices started slipping in October 1929, margin calls hit. Investors had borrowed heavily. Brokers demanded repayment. To repay, investors sold stocks. Selling pushed prices down further. That triggered more margin calls, more selling, more collapse. Within weeks, trillions in today's dollars evaporated. But the crash wasn't the real disaster. The banking system was. Banks had taken deposits and lent aggressively. When panic spread, depositors rushed to withdraw their money. The problem? Banks don't keep most deposits in cash. They lend them. That's how banking works. When everyone wants cash at once, the math fails. Thousands of banks collapsed. Credit disappeared. Businesses failed. Unemployment in the United States soared to 25%. Global trade shrank by roughly 2/3. This became the Great Depression. The lesson people took away was simple. Regulate banks, control speculation, create safety nets. And for decades, relative stability followed, until memory faded. Fast forward to 1997, this time the epicenter wasn't New York. It was Southeast Asia, starting in Thailand. Countries like Thailand, Indonesia, and South Korea had booming economies, rapid growth, foreign investment flooding in. But much of that growth was funded by dollar-denominated debt. Here's the dangerous structure. Local companies borrowed in US dollars because rates were low, but they earned revenue in local currencies. As long as exchange rates stayed stable, everything looked fine. Then investors got nervous. Thailand's currency, the baht, was pegged to the US dollar. When markets sensed weakness, they began betting against it. The government burned through foreign reserves trying to defend the peg. Eventually it snapped. The baht collapsed. Now companies that borrowed in dollars suddenly faced exploding debt burdens. The local currency earnings were worth less in dollar terms. Debt didn't shrink, it expanded. Capital fled. Currencies crashed across the region. Stock markets plunged. Entire economies contracted violently. This was the Asian financial crisis. It revealed something critical. Globalization links balance sheets across borders. A currency move in one country can bankrupt firms thousands of miles away. The structure again was leverage, but now layered with currency mismatch. Then came 2008. This crisis didn't begin with stocks or currencies. It began with houses. In the early 2000s, US housing prices rose steadily. Banks issued mortgages to increasingly risky borrowers. Why? Because they weren't planning to hold the loans. Instead, they packaged mortgages into securities, mortgage-backed securities. These were then sliced into tranches, rated by agencies, and sold to investors worldwide. Risk was dispersed, at least that was the theory. In reality, risk was obscured. Financial institutions borrowed heavily to buy these securities. Investment banks were leveraged 30-to-1 in some cases. That means a 3% decline in asset value could wipe out their capital. Housing prices stalled, then fell. Subprime borrowers defaulted. Mortgage-backed securities dropped in value. No one knew who was holding how much toxic exposure. Interbank lending froze. Trust evaporated. When Lehman Brothers collapsed in September 2008, it wasn't just a company failure. It was a signal. If Lehman could fall, anyone could. Credit markets seized. Global trade plunged. Stock markets crashed. Government stepped in with trillions in bailouts and stimulus. Public narrative was that greedy bankers caused a housing bubble. The underlying mechanism was a financial system built on short-term funding, extreme leverage, and the assumption that housing prices never fall nationally. Again, leverage. Again, confidence breaking. Then 2020, this crisis was different. It wasn't financial at first. It was biological. When COVID-19 spread globally, governments shut down economic activity to slow infections. Businesses closed, travel stopped, consumption dropped sharply. In weeks, unemployment spiked at speeds never seen before in modern data. Financial markets panicked. But here's what's remarkable. This time, central banks reacted instantly. The US Federal Reserve cut rates to zero. It launched massive quantitative easing. It bought government bonds, corporate bonds, even bond ETFs. Governments sent direct payments to households. Trillions were created and deployed in months. Markets recovered rapidly. Asset prices surged. But the real economy recovered unevenly. The irony. The fastest recession in history was followed by one of the fastest asset recoveries ever. Stocks hit record highs while millions were still out of work. The hidden mechanism here wasn't leverage in the traditional sense. It was liquidity dependence. Modern financial markets rely on constant liquidity from central banks. When stress appears, investors assume intervention will come. This belief itself changes behavior. It's called the central bank put. Now step back. 1929, 1997, 2008, 2020. Different triggers, different geographies, same core pattern. Phase 1, expansion fueled by credit. Phase 2, complexity grows and risk becomes harder to see. Phase 3, leverage builds silently. Phase 4, confidence cracks. Phase 5, forced deleveraging. Phase 6, government or central bank intervention. Crises are rarely about one bad decision. They're about systems optimized for growth but fragile under stress. And here's the uncomfortable math. Global debt today exceeds $300 trillion. It's more than 3 times global GDP. Governments, corporations, households all highly indebted. Debt itself isn't evil. It enables growth. But high debt changes incentives. When debt levels are extreme, raising interest rates becomes painful. Small increases ripple across mortgage payments, corporate refinancing, and government budgets. We saw this in 2022 and 2023, when central banks raised rates to combat inflation. Bond markets fell sharply.
Technology stocks corrected.
Some regional banks collapsed after depositors withdrew funds, exposing losses on long-term bonds. The system didn't implode, but the stress was visible. Public hype often frames crises as unpredictable black swan events. Reality is less dramatic. Most crises are gray rhinos. Large, visible risks charging slowly while everyone hopes they'll turn away. Take inflation after 2020. Massive stimulus met supply constraints. Prices surged. For years, central banks insisted inflation was transitory. It wasn't. The delay in response allowed price pressures to embed. Then aggressive rate hikes followed. Rapid tightening stressed sectors dependent on cheap money. The cycle repeats. What makes modern crises more complex is financialization. Asset markets are larger relative to the real economy. Derivatives markets dwarf underlying assets. Passive investing concentrates flows into large companies. Private equity owns increasing shares of housing, healthcare, and infrastructure. Everything is connected. Confidence moves faster than fundamentals. A rumor on social media can trigger bank runs. Capital flows move at digital speed. Contagion is no longer regional, it's instantaneous. But here's the subtle irony. Each crisis leads to reforms meant to prevent the last one. After 1929, deposit insurance and stronger regulation. After 1997, countries built large foreign exchange reserves. After 2008, banks faced higher capital requirements. After 2020, governments proved they would deploy enormous fiscal firepower. The system adapts, yet adaptation creates new vulnerabilities. Low interest rates after 2008 encouraged risk-taking elsewhere in tech valuations, venture capital, speculative assets. Massive stimulus after 2020 contributed to inflationary pressure. Higher rates now strain sovereign debt levels in multiple countries. The deeper issue isn't incompetence, it's structural tension. Modern economies require growth to remain stable. Growth often relies on credit expansion. Credit expansion increases fragility. When fragility becomes visible, confidence drops. Authorities intervene. Stability returns temporarily. It's a loop. And the stakes are higher now because the global economy is more synchronized than ever. When the United States tightens monetary policy, emerging markets feel it. When China slows, commodity exporters suffer. When Europe faces energy shocks, supply chains ripple worldwide. There is no isolated crisis anymore. The biggest economic crises weren't just destructive, they reshaped power. After the Great Depression, the US government's role expanded dramatically. After 2008, central banks gained unprecedented influence. After 2020, fiscal policy returned as a dominant force. Power shifts during crises, capital consolidates, weak players disappear, strong players acquire assets cheaply. Inequality often widens in recoveries. That's another uncomfortable truth. Crises hurt broadly, recoveries benefit selectively. So where are we now? High global debt, elevated asset valuations, geopolitical tensions, aging populations, climate-related disruptions, technological concentration. None of these alone guarantee a crisis, but crises don't require guarantees. They require fragility plus a shock. The shock could be financial, political, technological, environmental. The real question isn't whether another crisis will occur. It's what form it will take, in which hidden leverage will matter this time. Will it be sovereign debt, corporate credit, shadow banking, or something we're barely discussing today? History suggests the trigger will surprise us. The structure will not. Because every major economic crisis teaches the same quiet lesson. Stability encourages risk. Risk accumulates invisibly. And when confidence finally slips, the system reveals what was always there. The world's largest economies appear stable until they aren't. And the only thing more dangerous than visible fragility is the belief that this time is different. If you made it this far, you see the pattern. It's a sobering view, but understanding these cycles is the first step to navigating what comes next. Thanks for watching. Be sure to subscribe for more deep dives into the systems that shape our world.